Hello, ladies and gentlemen. My name is Greg Michaelowski. Today's date is August 5th, 2014. My lovely wife's birthday. Deb, happy birthday. I'm going to take a look at the euro versus US dollar. It's kind of fallen down in trading here today. We've got the 5-minute chart here for that pair, and a lot of times the market, a trend type move will start with a non-trend type move. Now, a lot of times it doesn't. A lot of times the market continues to be in a non-trending type environment. But today we had a 10-pip trading range throughout the entire Asian session. And we had London traders come in. And one of the clues that we as traders can look for is momentum, okay? It is first a break and then a momentum move. Now, it did break to new highs right here, but was there momentum to the upside? The answer is no. And the market came back down. And next time we moved higher, we tried to break higher again. We couldn't get above the high. And was there momentum to the move? And the answer is no. But this bar right here, where we fell below the previous low and started to move to the downside here, this is a momentum move. This is giving you a clue that sellers are starting to take control of the market. And you know that as well if you start to put a Fibonacci retracement of the move down from the high down to the low right here, where we start to correct. And where do we correct up to? We correct up to the 38.2% retracement, and that's it. So we find sellers in what I call the correction zone where risk can be defined and risk can be limited in this area right here, defined by the 38.2 to 50% retracement level. And that's set up for the next move to the downside, the next trend move to the downside. And I don't know how it all measures out here, but if I put a move to the Fibonacci retracement here, where do we correct? 38.2. And so the market's continued its trend move to the downside here, and that's important to understand, to know. It keeps you in trades as long as the price remains below this 38.2 to 50% retracement level. On the correction, shorts from up here, shorts from up here, shorts anywhere are still in the trade, and they've been able to take advantage of this move to the downside. I could probably, just looking at this chart, I could probably draw a trend line here across the lows here, and indeed I can. And we have 1, 2, 3 different parts, and it's kind of losing a little bit a little bit of the momentum on the downside. Nice little channel there. Our risks are defined by our channel trend lines. And we are in the midst of another type of move to the downside. Things are slowing down. We're seeing the corrections of this move to the downside be a little bit more than 38.2. So things are slowing down, but we're staying in the channel. As long as the price can remain below this topside trend line, we're okay for the channel. If we move above that topside trend, that doesn't mean that the trend is over. In fact, I'd probably just move this Fibonacci here and jig my 38.2 to 50% retracement, because this is a trendish like day, and I'd measure this peer area right here and say don't get back above the 133.94 level or above the 91 level, and the shorts remain in control. So things are moving in a directional bias off the 5-minute chart. You can see that nice and clearly. Now let's go to the hourly chart and see what started this whole process. On the 5-minute chart, we know that the market went up and tried to make new highs here. Why did it fail up here? And that is answered here on the hourly chart. If you go to the hourly chart and take a look at the 200-hour moving average here, this is where the market was making its highs right here, and the market couldn't get above the 200-hour moving average, and that kind of set you up for the downside move. And so when we started to break to the downside, we had that momentum move lower in this bar right here. Guess what was happening on the hourly chart? The hourly traders are looking to sell against that 200-hour moving average. So the lesson here, folks, is that you need to pay attention to not only what's happening in your shorter term charts, but also go out to maybe your hourly chart and understand what intermediate term traders are looking at. A 200-hour moving average that's holding up there, and a failure to get above that level and stay above that level is what helped the move to the downside. Right now we are below this trend line connecting the most recent lows. That level comes in at the, come on. All right, let's go here and go there. comes in around the 86 level. Remember, off the 5-minute chart, we're looking at the market staying below the 91 to 95 level, even below this trend line, and it looks like it's trying to do that. So bias remains to the downside here off the hourly chart and off the 5-minute chart. And on the daily chart, might as well complete the circuit here. If the market moves below the 50% retracement level, that's the 50% of the move up from the July 2013 low. This was a big swing move to the downside here. The trend move to the upside. 50% comes in at that 133.75 level. And if we move below that level, we went below it last week on 1, 2, 3 different occasions, but you see the time the market bounced off of that level. If we get and stay below that 133.75 level, it's going to open up the door down to 132.95. That's our next main target. Let's call it 133. As long as the price remains below 75 level, remember that caveat. So there you have it, a look at the euro versus US dollar. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.